Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. Today, we have the quarterly dividend payout updates for our Sweet Freedom, aka van life portfolio, plus helpful stock and strategy tidbits along the way. This is an update from episode 67 and 68 that we did back in September. We had to break it up because it was too long. Today's update's going to include a lot of tickers and numbers, so it may be easier for you to watch us walk through our spreadsheet in real time. Plus, the dinosaur references you're going to hear are going to make a lot more sense. To watch the video, head over to our YouTube channel or click on the link in the episode description. If risk scares the bejesus out of you, you'll be more interested in the conservative portfolio that we covered in the last episode. So now, let's dig in to our juicy payouts.
So, looky what we found. Dinosaurs. There's one. We call him Rexy. And this one over here, hold on, that's called Sue. That's Rexy and Sue. But if you look, Rexy and Sue have lots of money. We want everyone to be like dinosaurs with piles of money.
All right, so today we are going... Whoa.
Last week we went over the conservative retirement portfolio, if you remember. So that one wasn't, we weren't looking so much as high yield as capital preservation with higher yield than what the experts say is high yield. Like, I'm not sure if you're familiar with how they label high yield. High yield is anything above like 3%. I don't know what world 3% is high yield, but so this the van life portfolio has much higher yield. You can see by like this second column here, but we'll get into each individually here in a minute. This one here is how we're going to fund living on the road, and I'm hoping other people will do that as well. First one should look familiar. That's ABR. We hold that in both portfolios. I really like ABR, and the next week's podcast is about what I think 2025 is going to yield. I'll give you a spoiler alert. ABR is on the list. ABR yields 11.72. We made a 161.74, and we're up to 642.25 for the year in that one with 36 additional shares. We turned the drip off because the share price exceeded my buy, like it was above my buy up to price of 15. Its cents came down a little bit. It's down to like 14 something. But this is what I was talking about. Like, you have to have some sort of you have to monitor your portfolio. You can't just like set it and forget it. Otherwise you're going to be like, I mean, you still will be technically compounding on your compounds, but you can do it better. And that's what we do with a lot of these. Like ABR is one where I actually turned the drip off. I'll probably turn it back on at some point because it is looking like it's turning down a little bit. But ABR, awesome, saucy. Rawr! AFCG is the second one. It's a pot one. It yields 13.57. We made 102.94 in October on that. We're up to 380.13, and we've got 34 shares for AFCG. That's I don't know. The Republicans who are coming into power don't really like marijuana as much as the Democrats going out of power do, but the people like it. So like there's more ballot measures they keep voting on for pot, and like they keep passing. So I do believe that this one should be fine going forward, even if there's people that don't want marijuana legalized in office. The third one, AGNC, is a mortgage REIT. And spoiler, that's on my list for next year as well. Mortgage REITs, they don't actually hold physical properties. They just hold paper. They say, okay, like, so whenever you pay your mortgage to so-and-so. Well, that so-and-so is more often than not a mortgage REIT holding your loan. This one yields 14.91, which is pretty sexy. It does pay monthly, so went from 36.26 up to 37.11. 110 for the quarter and 348 for the year so far. We've got about 36 shares in that one as well. So I really like the monthly dividend payers
for sure,
because you get paid every month, but then you compound every month, and your numbers just go up and up and up and up, and it's pretty sick.
Yep, I'll reiterate again. The more frequently something compounds throughout the year, the more it's going to grow faster.
Next one is a newbie. AIPI. It says the yield's 35.71, but the AIPI, we've touched on it before. It's one that basically is just a collection of AI stocks, and they write covered calls on the stocks. This one's going to be pretty sick in 2025, I believe, and probably 26 and 27 and 28, probably up through 28 or 29 before they like start phasing out certain aspects of AI, and then the secondary generation of AI stuff starts coming in. But I'm hoping this actually phases out the first gen stuff and starts buying into the second gen stuff. So this one could be around for like a set it and forget it type index fund, but mainly that's specialized in AI, which will be fantastic. We've got nothing on it yet so far. We'll let you know in 3 months how much we make on it.
I was going to say, what were you saying about that 35% yield? You were going to say something and then you like train of thought switched.
It's 35% yield, so that's really good. If you look at the stocks this owns, if you got the dividend yield for each of them, it'd be like 1%. So you're making like 34% more than you would if you held the stocks individually. And they actually hold the stocks. That's like when we get down here to these ones, Coney, Crash, all those Yomax ones, they don't actually hold the stocks. They do the synthetic position where they don't hold the stocks, and I'd rather them hold the stocks.
Yep.
So that's a really good way to actually make money on the AI movement without actually having to hold the stocks. Now, I mean, you probably would make more in growth if you held some of the stocks, like say NVIDIA and AMD and stuff like that, but you would be getting no income. And our whole point of this portfolio is to have income. It's not to have growth.
And again, the growth stocks, it gets really confusing and hard to tell when the top is in, and you can only really get cash if you sell. Because we discuss all the time about when to get out of some of those, and it's
wait till the podcast that comes up towards the end of the year. You're going to see like my absolute banging when it comes to selling.
Yeah, that's a huge
I'm
sarcasm.
Freaking terrible at
sarcasm comment right there. But you'll see why in that episode that it's so much harder to do it that.
I don't know if you can see the dinosaur likes the Bobello. She just made a Bobello. Look at it, like
Bobo.
If you're not familiar with Bobello, we actually have a referral link about that. But it's like it's my replacement for pop
soda.
And it's awesome.
And in case you can't tell, Tim freaking loves dinosaurs.
Dinosaurs rock. Next one is AMZY. It's the Amazon Yield Max. We've been in this for, I want to say, 14 months now. And we're up upwards like 20%. So like I know like Yield Maxes get a lot of bad press. But if you do it right, again, we touched on it last week in the retirement one. If you do it right, you're actually mitigating the risk, and the rewards actually far outweigh the risk if you mitigate it, because you can actually double your income, your capital appreciation can double within like 8 to 16 months, depending on which one you hold. So
I will say they do have all the hallmarkers of like scams and things
they do.
That are,
so like
if
you've been burnt in the past, which we have, like you take you develop an approach to cover your ass, basically. It does yield 42.87%. So that's like 2 years. 2 years and you'll double your money in the AMZY. But we made 43.49, 52.36, 83.73. So we made 179.58 for the quarter and 500 for the year, and we've actually accumulated almost 27 more shares. So like
that's a lot.
And I don't have the drip on this all the time. I turn the drip on, turn the drip off, depending on
what you want to do with the money,
depending on what the share price is going on.
And that too. I was going to say that yield is all over the place because it's constantly changing, because it's based on whatever the heck they're making from their options trading.
The next one is one that if you don't have it, you should have it, and if you don't have it, I don't know why you don't have it, because we've been talking about it for years now. ARLP, it is the second largest coal company in America, and everyone hears coal, they go, ew, gross, coal, dirty, dirty, dirty. Whatever, get over it. It's happening. It's going to happen. It's going to happen for sure the next 4 years, because we're all about just energy.
Did you know that they actually have a coal museum up in Jim Thorpe? And Jim Thorpe's one of those places in the Poconos that like everybody goes to. I didn't know they actually had a coal museum. Now
the yield currently is 9.92, but this is actually variable. It flips, like they basically pay out what they have left over after their bills are paid. So this is sometimes like 16, sometimes 8, but I'd say it averages about 12%. So it's at the low point right now. We made 87.05 the last quarter in that. We've made 332.73 for the year, and we've got 14 additional shares. So that's pretty sick.
Woot woot.
BitO. This is how I would play crypto. Like if you don't invest in companies that own Bitcoin, like straight up, like micro whatever it is, SCMI or whatever, like they invest in Bitcoin and they own Bitcoin. BitO they trade futures on Bitcoin. And like pretty much anything that doesn't hold Bitcoin that's crypto related trades BitO. So if you actually look into the details, most of the things that like say you find like a yield max that trades Bitcoin, or you find a Roundhill that trades does Bitcoin things, they are actually using BitO as their marker. So why would you invest in the other things when you could just invest in the thing itself? I mean, it does yield 57%, which is more than those other ones do that trade options on the BitO options. So
yeah, that seems a little risky to go through the secondary.
But we're making a good amount of money on BitO. You see 88, 16, 85, 15, 77, 58. So we made 251 the last quarter, and we've made 800 for the year so far. And we have 26 shares. Yeah, 26 shares of BitO.
Accumulated.
Oh, I see here on, if you see, I don't know if you can see this on the right, but I bought AIPI on 11.27. So we'll get our first dividend here in December.
It's gone up a good bit since you bought into it, hasn't it?
Yeah, it's trading about at 52.
So if you guys want to be in the know when that happens, because we're doing this podcast pretty well after we did that, you're going to want to get on the email list. There's a link for that in the show notes. Every week, Tim basically summarizes everything we bought and sold.
I try not to buy a lot, but like, stuff happens. Like this week, something happened that would just shock the crap out of me that I didn't wake up thinking, hey, I'm going to do that today. And I did it. And I was like, didn't see that coming.
Well, again, and it's a good strategy to do it based on like when metrics get hit and then you're watching trends, you see stuff in the news and then you're like,
We'll get to it here in a hot minute.
Yep.
Next one's our bullet share, BSJU. There's like 26 different bullet shares, so you can pick and choose whichever ones you want. I personally prefer the ones that are like at least 5 years out. They have a 7-year out as well, but I like the 5-year out one. We're
going to actually do an episode on that because there is a strategy and they're not all created equal. Blah, blah, blah.
Okay, this one yields 6.84, which is pretty good to just have your cash sit around in something that yields 6.84. And these numbers are actually going to bounce around because when I buy stuff, I use the bullet shares. And then if I have cash left over, I put it back in the bullet shares. So we've only made $20 so far in bullet shares. So, I've been buying. Buying dips and doinks and whatever else. Doinks. Next one is Civi. That is my play for energy. I have 2 plays for energy next year. One of them Civi. I like Civi a lot. It's super undervalued. I think it's ridiculously undervalued because of the price of oils went down a lot. So it yields around 10%, but this is variable again. And like if you look it up in Yahoo Finance and Vanguard, it'll say 3 point something because it doesn't take into account the special dividends. Like
so
their base dividend is 50 cents per share, but then they will tack on specials when they have cash left over. So like it's about 10%. We've made nothing in that so far because we bought that in September. So we get our first dividend this month.
Ooh, I'm so excited to see what it does.
Now, the next one, if you don't have this, I don't know why you don't. I'm just saying, like, I've been talking about it forever. Coney, C-O-N-Y. It's the Coinbase yield max where they write synthetic options on Coinbase. The reason that you have it is not because you believe in Coinbase, because I think Coinbase is like it's the absolute worst.
I cannot even say one good thing about Coinbase.
But you have it because people relate Coinbase to Bitcoin and cryptocurrency. And cryptocurrency just popped off the end of this year, and it's going to pop off in 2025. So if you're not in Coney, you should be in Coney, because right now like the last month's yield was 168%. Like you literally can double your money within like 6 months in coin.
And that's the thing with the yield max is when it's volatile, and right now crypto is going up, so you're going to get price increase as well as the dividend payout with this. And Coinbase basically is the only freaking crypto option for people who are U.S. citizens, because the government has basically like DQ'd anybody's ability to be in pretty much anything else. And it's the easy. I mean, there are a couple other ones, but again, Coinbase is the easiest of them. But I hate it mainly because they just literally nickel and dime you in fees.
They're horrible. They're terrible. Like I'm
not even sure nickel and dime is the right word. It's like quarter and dollar.
I don't recommend Coinbase stock, but I recommend Coney.
100%. Look at that yield.
We're made 102 in September, 118, 119 in October, and 216 in November. We made a 437 for the quarter, and we're up to about 800 for the year so far. And this is one that, depending on if this price if the current price 1654 gets above my buy up to price 1850, I will turn the drip off. So we've made 33 shares just doing that, drip shares this year, and it wasn't on for the whole year. It was only on for like, I think, I want to say 6 of the 11 months.
Even if you don't like crypto, it's a great way to make money from other people who, for whatever reason, believe in certain things that don't make sense.
No, the next yield max was an experiment. So, like, in all fairness, whoopsie. CRSH, it is the Tesla short for yield max.
So TSLY is the
So I bought this CRSH like right, when did I buy this? 10/18. You know that Tesla took off at like 11.5 whenever the election was called. So this thing has literally went straight down from like $12 down to $7 within like a couple weeks.
So my question is, have you got your initial has the fall recouped from the dividend payout?
No, like I've only made $18 and I have like 500 in it.
So no.
No. But it has a 66% yield. I mean, if you're willing to take like a 50% price loss, I mean, it really can't go much lower than 7. So, I mean, maybe 5. 5 will be like the floor of this because all the yield maxes hold treasury. So I don't think they can fall to 0 because they have treasuries backing some of their portfolio.
Yeah, so just remember, this is an experiment. We're kind of testing the negative side. I like the idea that the YieldMax is doing like the shorts.
Well, they have a Coinbase short, which is the FIAT.
Which will be good when we actually go into a crypto winter.
Which will be good at the end of 2025. I'll probably do the experiment with the Coinbase, the CONY versus the FIAT at that point. They have a NVIDIA short, which I wouldn't
put it on the rag.
Recommend ever until like the AI revolution has stopped, which will be like, when you're dead.
When you're dead.
That one is DIPS, and they have the Tesla one, which is CRSH. So like
I think the Coney one would be the best one to be able to
that
play
one.
The
I'm going to get into that one probably the end of 2025, beginning of 2026. I'm going to actually take the same amount of money that I have in Coinbase or the Coney one at that point. I'm going to put it in the fiat one and see what happens. My theory on this is if you have the Coinbase, the Coney, and you have the fiat, you're playing both the long and short, so you should, in theory, have minimal price depreciation amongst the two of them while getting all their gains. I'll let you know more.
If that makes any sense. If one goes up and the other one goes down, they basically balance out. So you basically leave your price change, but you make all your yield.
And that's the way to cover both sides because I never know what Tesla's going to do.
So we'll see what happens with that.
Okay. Next one. Camping World. You guys should be familiar with this one by now, this dirty whore. We've had this one for like 3 or 4 years now. It only yields 2%.
You should stick your dinosaurs on them.
It is what it is. It like at this point we're down like 17% still. We only made $10 because they cut their dividend to something ridiculous like 8 cents or something like that. So,
went down like 80%.
So it is literally what it is. Next one we sold. On 10/18, we've mentioned this before. DSU is one of the bond funds that was overvalued. It fell back a little bit, so you could in theory get into it because I have the buy up to of 11. It's at 10.86. But is that worth? I don't think it's worth it. You're only getting like a 11% yield, and there's a better one down yonder that we'll get to in a hot minute where we put all of our bond stuff into. We made 39 for the quarter and 190 for the year, and we got 15 drip shares, but again, it's been sold, so I just included this because it actually had dividends that we collected.
Mm-hmm. We agreed on that before.
This one is the one that I woke up yesterday and didn't think I would have done what I did, but I literally just sold this one. EPR.
He does that.
EPR has been outstanding, like ridiculously good. It only yields 7.5%, but it has plenty of room to grow. Probably 12 or 15% more appreciation before you get into the point of like maybe I should get out of it type. But it's a monthly payer, so you get monthly dividends. Not a lot. You can see I only got 1.31 for the quarter, and we had $3,000 in it. So you're not making a lot on your money. So we only got 4.5 shares for the year. The reason I got out of it was I found a better investment that yields about 7% that I got into. That has more room to grow, and it actually, I do believe, will generate better returns in 2025. So I'm like,
it's the same sector, right? Energy.
No, this is real estate trust. That's like the ski lodges and the movie theaters and shit.
Oh, my bad. I'm confusing that with
this one.
Yeah, the next one. I had E and R in my brain. So
yeah, this close. One I got out of. And what the hell did I buy? It'll come to me in a hot minute.
Didn't you put it into Civi or AIPI?
So the next one, while we look up what I put the money from EPR into, because like my memory is astounding. Next one we sold as well in September. I sold EQ&R, and I mentioned why a couple times now. EQ&R is an outstanding European gas company that yields 12%, but I don't believe European gas companies are going to fare too well in 2025, 2026, and 2027. So I got out of it. we got one dividend for $42.70, which got us one share. But like, I put this money into one that's down the line here that's way better, in my opinion, for what we have going on. Next one's one of my babies. This is the sister of the AIPI. This is FEPI. This one holds the actual shares of like Microsoft, Tesla, NVIDIA, whatnot. It only has a 27% yield, so I mean, that's kind of weak, right? I don't know what the buy up-to price is because I don't know what the market's going to do. So I just put 53.50 in this one, as well as the AIP one. I put 52. That's at current prices. You have to wait to see what the market's going to do. I do believe the market's going to go up in 2025. So if it does, I'll adjust these prices the next time we do this. But this one just gives us banging returns. We get 93, 93, 97. So
yeah, FEPI's awesome.
We've got 283.01 for the quarter and 587 for the year so far, and we got 11.34 shares. I really like FEPI, and I'm pretty sure I'm going to like AIPI, but FEPI is probably one of our main income generators along with CONY.
That's why he was in a big hurry to get AIPI up to equal value.
Like, I'm not sure if you like. I know we've discussed it before, but we have like income generators that we use as paychecks. That's why the drip over here, there's not a lot of shares. You see this 11.34. Like, obviously, we've made more money.
Even though that yield's incredible.
We've made more money where we could have had many more shares. Like, I just use it as cash when I'm feeling like I need cash.
And again, that's a strategy that we use for the higher yielders because we're trying to get our initial capital out to take risk off the table. You'll see that as a common strategy we do with Yield Max. We're doing it with those.
Next one is I'm pretty sure not well-known BDC, FSK, Fisker. Not a lot of people know about Fisker. They know about Hercules Capital right below it. And they know about Main Street Capital down here. But like not a lot of people know about FSK. They have outstanding margins and a really good yield. 11.52 yield. And it's undervalued. It should be about 24, 25 range at the current market. It's at 22. So you have like, what is that, 8% to grow or whatever. We made 83 in October. So we have 170 total for the year. It's a quarterly payer. That's the only problem. Like I like the ones that pay monthly, as I mentioned. But we got 8 additional shares of SK, and they actually will pay out a special dividend pretty much every time they pay out a dividend. Like their base dividend, I want to say it was 48 cents or something like that, or 54 cents or 60 cents, I forget. And they pay out like a 6 or 8 cent special dividend every time they have a dividend, so that's pretty nice. I really like it. You should research that one. If you haven't done that already, or you took my word for it and got into it, awesome, because you're making some good money on this one. BDCs, when we do the 2025 prediction, I think BDCs are going to be kind of a mixed bag, and I'll explain why when we get to that. But if you have the right ones, it won't be a problem. Next one is like the baby of the portfolio, HTGC, Hercules Capital. It yields 10%. It's almost overvalued. This is one where I've been turning the drip on and off. You can see over here, I got no drip shares for the last quarter where we made $140 because it was trading at like $22. So we just took it as cash and we used the cash, put it in something else. But we have 14 shares for the year so far. So that's good. This is a really, really, really well-ran BDC. Here's another problem child. We mentioned this last week with the retirement portfolio. Yeah. We sold all the positions in the retirement portfolio of IEP, but we kept half our position in the Vannon one because I do believe it will turn around at some point. Like the numbers are there, the revenue's there, like they have everything there. They just keep effing up in the worst possible ways with certain things. So I mean, it yields 18%, so it's not terrible, but like we've lost so much money in this one. And we'll just write it down. This is like the Titanic for us. We'll just keep going down. We'll be like,
well, is it that really, or is it? Because what we'll do is like a lot of times we'll look at something and we'll be like, okay, should we cut our losses? Should we not cut our losses? Is this something we would get in if we weren't in it now? I would
get into this at the current price.
That's what I'm saying. So there's no sense in liquidating our entire thing. And the reason that's why we were still in it for this portfolio, but we took it out of the more risk conservative retirement portfolio that my mom has.
That's what she said. See, it's like she pays attention when I talk sometimes.
I do listen.
Rawr! Okay, next one, JEPQ, one of my faves. Love it. I remember when we first started this, I guess it was controversial at the time. I said JEPQ is better than JEPI. And
we got so much kickback.
People gave me so much shit for that.
Kickback.
Like, are you kidding? JEPI is far superior because all the experts love JEPI.
If that is literally their justification.
So I'm hoping you got into it because it's overvalued like a MFer right now.
You're sitting on quicksand.
I'm just saying, like it yields 10%. So it's like it's $3 overvalued. So if you're in it, turn the drip off. If you're not in it, you're gonna have to wait for a pullback or for the next update where I can look at like what they bought and what they sold the previous quarter. we've already got our initial investment back. That's why these numbers over here are so low, 27. We made our initial investment back. I took all the initial money out of it. So like the 3,000 we have in there is like literally all profit. Like it's 3,000
free money.
3,000 in profit on a position size of 8,000. So we're at 3/8 or whatever that is. What's 3/8? 40% all profit. Right.
Well, now anything it makes is like infinity profit.
So we have the drip on this one, even though it's overvalued, because
we have no money on the table, and that's
I do foresee this one going up more.
set it, forget it forever.
So yeah, we made $256 so far this year on a $3,000 position, which is pretty good. And we got 5 additional shares. Yay for us. This one here is another one I don't think people know about unless you listen to us.
KRP.
KRP is a royalty play in the Permian Basin that basically they just buy land that has oil wells on it, and they collect basically rent from the people that drill for oil and ship oil from their locations. It's fantastic. It yields 11%, and the profit margins don't matter in this one because they don't have any debt because they own everything. So we're making pretty good money. We made 62. And now I think we have I want to say 2,500 is all we put into this one. And we made 253 for the year so far and 16 additional shares. I do really like royalties, but it's very difficult to find good ones. And this happens to be one of the best.
Of the best.
One of the best small cap royalties I could find. And
small cap's fun too.
So that was one to look into because, again, it's in the Permian Basin, which is where we're going to be drilling for a ton of oil in the upcoming 4 years under the Trump presidency. Next one is another one of the better ran BDCs. It might be the best ran BDC, depending on who you ask.
Which is why it's the most popular?
Main Street Capital. It only yields 5%. Here, the only drawback I have on it is this. I was
going to say, notice, the more popular you get, the lower the yields tend to go.
And we don't really collect too much in this. We only got 150 for the year so far, which is only 2 additional shares. It's been the reason that September was high because they actually paid out a special dividend on top of the normal dividend. So you see 1078, 1083. So I'm betting this was probably 1070-ish around there. Then the special dividend tacked on the extra $13, $14.
Which is nice.
It's really good. It's really well ran, and it's the bomb.
That's another
it's overvalued right now. For me, when I say buy up to price, I mentioned it last week. You could buy at the current price and still make money on it, but to actually have a super high dividend yield, this is the price that I wouldn't pay over. I think if you buy it at this price, you're getting a 7.5% dividend as opposed to this price here, where you're getting a 5% or 5.4%. Yeah,
so basically that buy up to price is where Tim wouldn't buy above it.
It's not like other ones where they have a buy up to price where they have it where they think it's going to go. Most of the time, a lot of the publications buy up to price is where they think it'll cap out at. There's other people that they'll have a buy up to price to a certain percentage. If they look at Main Street Capital, they would want to have at least 5% dividend yield. So they'd say the buy up to price would be 54.50 because they don't want any less than 5% yield. So you have to know your publications and the people that are doing the research that you read about. For us, it's me. I want a high yield. So that's why the buy up to price is where they're at. I want a high yield.
And you can find them. You can be choosy.
I haven't had a problem with them yet.
Yep, you can be choosy.
Next one is a cigarette maker, and I know a lot of people have tobacco problems, but
as you can see, Tim is not one of them.
As I get ready to pop in one of their products, they make my num-nums. MO, Alteria. We have a bond in her mom's account, the retirement account for an Alteria bond. It only yields 4.5%, where you can actually hold the stock. It yields 7.07%. This one's just shot to the moon. We're up, I want to say 40% in this one. We got it really good price. We got it $30
And here's a prime example. If you hate or think that tobacco stocks are the devil, somebody's buying them because the price just shot up. So make money from the addicts. I do.
For these two, I'll make a quick note here of something. This is why you should always have bullet share money available.
Main and Mo.
Main Street Capital and Alteria, I wanted to put $5,000 into, but I only had so much in my bullet shares at the time, plus dividends coming in. So I was only able to put maybe $4,000 between the two of them in it, and it reflects in the dividends. You see these $10 dividends, and Alteria is only paying us $40. Had I got what I wanted to, this would have been probably $100, and this would have been about $50. But because I didn't have money in my bullet shares, I didn't have enough money to buy stuff, and then I would have to sell something to actually supply this.
And that is another reason you got to be really, really intentional. And the main reason why we don't buy at a higher price for a lot of the valuations, because we want to have more shares at the lower prices, and then you got to pick and choose. So that's another reason Tim sells some stocks that we wouldn't if we had other capital free. It's one of those things. This is actually one of the pitfalls of just not having the extra capital.
Yeah, we only got 2 shares in MO for the year so far. That's depressing, but whatever. It is what it is. But we're up like probably 40-some% in this one and 50% in this one. So like I got them at the right price. I just didn't have enough capital. And I was like, oh, well, I should be able to like get some dividends and everything. But they both took off like pretty much as soon as I bought them. Like this one went up like 8%. That Main Street Capital was up 8% the week I bought it, and MO is up I think 12% within 2 weeks.
Well, and I think the other thing that happened was like some of the other stuff like hit bottoms, 52-week lows, and we were like, oh my god, there's so much stuff to buy and not enough money to go around. So it's like, again, you got to pick and choose things.
So that's that. And here's another redheaded stepchild. Yes, here's this, our old friend MPW.
Our old friend. And you know, it's so funny, true story, like the license plates that they're, I guess, like issuing right now in our state, they're at the MPW like issuing. So it's like everywhere we go, we see MPW. It's so freaking annoying.
I mean, the good news with MPW is they fixed their biggest problem, which was their client, their largest client. They fixed that solution. They fixed that problem in bankruptcy court. So in theory, their revenue and their margins should get better going forward, because they basically just took all the hospitals from the largest client and they distributed them to other ones. But in the meantime, damn, it yields 7%. So I mean, that's something. And we've got 42 shares this year, so that's another something. But this one here, I would avoid until you start to see this share price of $4.39 get back up into say the $6 range. Then that's like my buy up to price will obviously be reflected once it starts doing that.
Are they going to get delisted?
No, it's if you go under $1.
Oh, okay.
They make a lot of money, but they owe a lot of money in debt. And the reason they have a lot of money in debt is because they're doing all this crap with people that can't pay their rent and everything. So like this one of the 3, Camping World, Icon, and MPW is the one I'm most confident in that will be making you lots of money in the future. Where the other two I'm like, eh.
And speaking of paying rent, one of the things, it's a pain in the butt. Like yesterday, I totally just realized on the 5th, it was late on the 5th that my renter hadn't sent me the freaking rent check. And I was like, really? Are we going to go into this whole like late fee thing? And I was sitting here waiting, and then I completely forgot about it. Then I remembered, and she must have sent it over like right before midnight. I was like, really? I hate.
You can see by this, we only made $30 in the quarter, and we made $180 for the year. That they cut their dividend again, which is
muy male.
Bad. They cut the dividend again. It went from
that's a very sad frown face.
15 cents down to 8 cents. I think the dividend cuts are done. Be my guess, but you get a lot of shares. Like even with that $28, we still made almost 6 shares.
I mean, that is the nice part, that it's down as much as it is. So hopefully, when this thing turns around, because they did fix the problem child, we should actually recoup a lot of the money we lost, and we'll be picking up a crap ton of shares. So we should actually make money. Should.
Next one is probably one of the better yield maxes, if not probably the top 2 best. I would like it's MSFO, which is the Microsoft Yield Max. It only yields 35%, but this one, no problems. Like you see 27, 32, 33. It just keeps going up and up and up. We made 347 for the year, and we've got 18 shares. I have this drip on in this one. This is one of the few riskier investments I have the drip on.
Because?
It's because Microsoft is, like, whoever's running this is killing it.
Okay.
Like, even when it was really bad, like, these all started at $20. That's why it has the buy-to price at $20. Even when it was really bad, this one only ever went down to like 15, whereas like the Tesla was down at 8, the other one was down at 12, Coinbase went down to like 11. Even Nvidia was at like $15. Microsoft never went like below like maybe 16. Like this one's really well ran. Whoever's doing this one knows what the hell they're doing.
So this one doesn't have the NAV decline, so that's nice.
MBXG is in both portfolios, but this is just a really, really, really good closed-ended fund that's ran really well.
That's a little overvalued.
It is at this current time, but I mean, you could still get it at 13, 18, because that would still give you a 9% yield. You're getting 9%. They hold a lot of tech companies and a lot of research
which is totally worth it.
Like technology research. Like, so this is like a closed-ended fund that mainly deals with like tech stuff, which is awesome. 9% yield. We've got 31, and I did sell some shares when it got up to like 14 something. So our dividend went from 31 down to 16, but I will never sell all the shares in this one.
Never ever.
Never ever. So I sold half the shares. So I took profits because we were up 70% in this one or something. So I just took a good chunk of profits off the table. So we've accumulated 30 shares for the year. So like this one will just compound again. Probably like 3 or 4 years. We'll probably sell half the position again at that point.
And then I assume we'll have all our money out and we'll just let it ride.
Now this one, NEP, renewable energy. It's like, if you're familiar with like the electrical companies, NEE is its parent company. NEE is like the largest electric company in the South in Florida. But it's renewable energy, and like the incoming policies aren't really renewable energy friendly. So this one went down a lot after the election. We were up like 50% in this one, and now we're down like 10%. So it dropped like 60% in like 2 or 3 weeks.
Wow. And again, that was something we didn't really expect to happen.
But it has a really good yield of 21%. And
I was gonna say that yield has to be insane.
We make pretty good money. We made 324 for the year, and we got 13 additional shares. So this is probably just to hold it and see what the heck happens type one, because we only have like
because we see the future
3,000 in it or something.
Being pro this renewable energy type stuff, but I think it is gonna lag behind like nuclear and all this other stuff. It's like trying to get the AI crap off the ground.
And then this next yield max, it basically has the conversation: do you want income or do you want capital gains? Because this is the NVIDIA yield max, NVDY. It yields 74%, and we've made a just ton of money in this one. Like, there's no other way to say it. Like, we've made so much money in this one. We've sold all of our position. Our initial investment's gone, and we still have like $4,000 in this one.
So this is all profit,
which is all dividend. We're making 60, 50, 50, 60, so we made 861 for the year, and we got 26 additional shares. This begs the question: do you want the NVIDIA stock, which is up 200%, or do you want the NVIDIA yield max, which is up over 100%, but you get a lot of income from it?
200% from what time frame?
For the year.
For the year.
I think NVIDIA is up like about 200% for the year to date, 2024, and I think NVDY is up 118%. So it's like 82% less growth than the actual stock it's writing options on. But at the same time, we are an income portfolio, so we want the income.
But at the same time, too, you have to remember that NVIDIA did a stock split, and typically when stock splits happen, people get more excited and push the prices up again. I think had it stayed up at the price that it was at, it probably wouldn't have grown as much.
So the simple solution to the whole conundrum that I just mentioned
by both
was I took a large portion of my NVIDIA 861 for the year, and I actually picked up NVIDIA
when it dropped.
NVIDIA when the price was down at like 112.
Yep, because again, stock split, we know it's going to eventually get back up to the price that it split from. So that was my solution. I don't know what other people's solution might be. They might just own the NVIDIA stock and just tip capital gains. But what you could do is you could buy the NVIDIA, get all your stuff paid back, and then NVDY, and then take all of the profit at that point and then just literally keep buying NVIDIA over time. And like, you have no capital invested in wherever it goes, it goes.
I mean, another option would be to actually use your dividends from this to buy in NVIDIA and then write your own options on it. But
I mean, you could do that too, but
I can barely.
I like my free time.
I can barely master this stuff here. I don't want to learn how to do options. I was going to say
that I don't even have right now, but when I have it, I'd rather be doing something else.
Next one was sold at the end of this was sold the last day of November. This is a really, really, really good bond fund PDI. It is at least 100% overvalued, so that's why we just took our profits and said, "All right, sayonara." I mean, I have it at 19 for a buy of 2 point. That would give you a 13.75 yield, but like in all actuality, this you have to wait for a dip where it comes back down to like the $13 to $14 range where you can get the return that we got on it. We got damn near 50% return on a bond fund.
Yeah, that's insane. So we will be getting back into this one when it drops. So basically just keep tuning in and we'll tell you when that happens.
Yeah, because it's a monthly dividend payer, so you're getting drip shares every month, and it's really well ran, but unfortunately. But what we did...
Well, you cut it and you bought it in the next one.
The next one, PHT, is a vastly undervalued bond fund. It's like probably 30% undervalued. So like it is right where PDI was like 2 years ago when we bought PDI.
So if you want a potential another 50% gain, like I would kind of maybe follow what Tim's doing.
But PHT is not as well known as PDI, and I think PTY and like the PIMCO ones are like where everyone goes. That's like where the popular crowd. PHT is not real well known, and it only yields 8%, but it is, like I said, it's at least 30% undervalued. So you're going to get 8% a year until it probably 2 or 3 years for it to climb up to where it should be. We only have got 231 for the first dividend in November because we only have
not a lot of shares.
Not a lot, like 1,500 or so in that, but
whatever.
I believe we'll be fine. Then here's another newbie, another BD. This is a BDC, PTMN. It yields 16%, and it's undervalued by about 15%. So like we got 41.40 the first month that we had it, and that got us 2 additional shares, 2.5. So I like this one for
already, yeah.
like maybe a 12-month to 16-month hold. Like we'll probably be out of this one by the end of 2025 or the beginning of 2026. Because BDCs, I don't want, like we have a lot of exposure to BDCs, and it is what it is. Here's our Queer Tip, our preferred share. It has $100 par value, so it's 58% undervalued, but I say 45 because it's been
the par for that's really 100.
It's been band trading between like 38 and 52, so I figure 45, and you should be able to then figure out your own band. But we make a lot of money in this one. We made $734 for the year. We'll make about $1,000. So we get a dividend coming up here in a couple of days in this one. And sometimes the drip, like if you're in Schwab, you can turn the drip on and off on this one. If you're in any other brokerage account, you can't. So that's one of the reasons I like Schwab, because it doesn't like limit me in that. Sometimes the drip's on and we get 6 shares, and sometimes the drip's off and we just get 250 in cash. We put it in something else depending on what's going on with this one. Currently, it's the drip has to be off because it's pretty high priced.
Next one's new too, isn't it?
The next one's another new BDC. Our way, it yields 15%, and this is a monthly dividend payer. So this one actually has better potential than this new one, PTMN. This one's a quarterly. This one's a monthly.
We like those monthlies.
And this one's undervalued by about 20% again. So we'll let you know, like in the next.
I was gonna say this one's so new we haven't even got a dividend yet.
I just got one. I think it was $80. I'm not sure.
I don't trust your memory.
This one we've been in for. This probably is our longest holding.
RYLD.
It is a covered call strategy on the small caps, the Russell 2000 stuff. Yields 12%. It's still undervalued. We get a lot of money from it. Like we got $430 for the year. We're up to like I think 5,000 total that we've got. So many additional shares. You see that 26 shares for the year we've got dripped back into this, and this one just keeps growing and compounding and growing. The only drawback is the small caps performed pretty nicely in the latter half of 2024, and this one's price didn't really appreciate too highly. That's part of the problem when you have covered calls. Like there's not a lot of, you don't get a lot of upside. It takes forever for the upside to realize. But the next one I'm super excited about.
That's a new one too, right?
Yeah, we bought this in the beginning of September, or beginning of November. SRV, it is a closed-ended fund that deals in MLPs, and most of what oil, basically MLPs. There's a lot of MLPs, but basically
does this have a K1?
I don't know.
Okay, we'll find out.
It yields 12%. It's undervalued by 10% right now. Monthly payer, and we've been dumping money gradually into this one, so this number should increase quite nicely. I believe oil is going to have a really good 2025, especially American oil, and I think all of their companies are American that they hold in their portfolio.
So Trump staying American, Trump being in oil.
If you remember up top there, we said EQ&R is one I really like, but it yields 12%, but it's a European. Well, this is a 12% yielder that's American, so I basically traded that one for this one.
Because Trump
trade, hashtag winning. Next one should be well known to everybody,
Trinity.
14% yield. We've got $170 in this one, $171. And we've got, this is one that I had to turn the drip off once this year because it was too high, but then I've turned the drip on twice, so we got 35 shares, and I think I believe the drip is off at the current moment, and we'll get
I'm really shocked at how low price that still is somehow.
We'll get a dividend in the beginning of January, which will be cash at $170 some in cash. So yeah.
Like that generates a crap ton.
And then TSLY is the Tesla Yield Max. It yields 97%.
And we said not to get in this one a while back, but it hit really low. And with Tesla has
a bunch of going on. If you don't know.
Yeah.
If you don't know, you should know. The Tesla, like besides the
A lot.
The cool cars and the just ridiculous looking trucks. Tesla has way more than that going on.
Behind the scenes,
and
that might not be
Elon
completely
Musk
out there
is
yet.
like BFFs with the president. And yeah.
Yeah. So
SpaceX,
basically,
Starlink, there's so much going on with Tesla that like if you can make money from it, you might as well. You can own Tesla stock, but Tesla stock's like $300 a share. This is $14.50.
So we decided to get back in this one, and I think Tim bought it. What does that say?
I bought it at the same time I bought
Mid-October-ish. And it's gone up since he bought it.
Yeah, this one, like if you remember Crash from up top where I had Whoopsie Daisy, well, I bought them at the same time because I was going to run the experiment.
Yep. So this one has gone basically straight up since he got it.
So the problem is the experiment is kind of flawed because the data is just all positive.
Yeah.
So
you need a more neutral market.
There's no real downside to Tesla right now. Next one is one that you should know.
You didn't say how much we got in that one.
26, 27.
Did you say?
Yeah.
Well, whatever. Yield's 97% in Tesla. Just
next one, if you're not in it, you should be in it because I told you all about it forever now. And that is UAN. It's a fertilizer one. It's awesome. Yields 8%, but that like it's variable. Sometimes it's 8%, sometimes it's 20%. It all depends on what cash they have left over at the end of the quarter. It's overvalued now because it literally like went up like 40% within like a week. So,
oh my God.
Like in the process of putting this together, it went from like $67 up to $84. It went up a lot.
Jesus.
We made 61 in November and we've made 335 for the year, which got us 4.5 additional shares. But this is one that you should have because
there's no way fertilizer's going away.
One aspect of life that we know is there's more people and more people require more food and more food's going to require more land and more land is not necessarily going to be fertile land, so they're going to use fertilizer.
Well, and if you've heard anything about the nutrition value going down in plants and stuff, like fertilizer is going to be a major necessity for supplementation to get people what they need in the crops that are growing. So I don't see fertilizer going anywhere.
Yeah, so there's fertilizer. You want to be in fertilizer stock. There's another one out there. I forget what it's called. And I think Scott Miracle Grow, but it's like $170 or $200, whereas this one's only $80 and it has a higher yield. So I like this one better than
so obviously Tim picked this one.
Miracle Grow. And
you apparently picked right and got in right because if it went up that much in price, like another freaking Oracle play.
Next one is ULTY, I'd say. Basically, they just write options on a bunch of things I never heard of. And we make a lot of money in this one, but like at the same time, there's a lot of like NAV erosion going on. Like
ULTY is the yield max that doesn't have like an underlying stock, right?
Yeah, they just write options. They have an office that says we're going to write options on some company no one's ever heard of, and it generates 93% per year. Like we're making 190, 175, 176. We made $1,000 so far in 2024, which has got us 57 shares. It's undervalued. It just keeps going up. And like, this is like, once we get on the road, I'm going to turn the drip off this one permanently and we'll just be collecting. This will be like
cash cow,
like a seventh of what we need to live on the road. If it goes to zero, so be it. That's why we have all these other things going on. I like it. It generates a lot of money. This one's a new one. The next one's a new one.
UPS.
Yeah, UPS.
We did buy a lot of stock since the last time we did this.
UPS only yields 5%. So, I mean, it's it's probably the lowest yielder we have.
But you bought this because
it's so undervalued.
Yeah, I was going to say it dropped its face off.
It's ridiculously undervalued. Like, this is probably, I would want to say, like, realistically 70% undervalued.
And didn't you say you were watching it for like a whole year and a half or something?
Yeah, I was looking to pull the trigger. There was two stocks that I've been watching since before we started the podcast. One was UPS. The other one's UGI.
Yugi. We haven't got into Yugi, have we?
Yeah, we haven't got into UGI yet. But UPS finally, like, it just got to the point, like, I got it $107, which is ridiculous considering it was just trading like $270. So I'm saying, like, this one is realistically like 70% undervalued.
It's like early Black Friday shopping right there.
And you get a 5% yield while it bounces around. But then if you think about, like, the context of the macro trends, like, what is one thing that everybody does is they shop, and where does they shop from? They shop from Amazon, and Amazon uses FedEx and UPS. FedEx is about fair valued price, so UPS is the next logical conclusion, and it's undervalued by so much. So it had a really earnings where it dropped like 30%, and as soon as it dropped, I was like, yum. Same thing I did with Intel. I was like, oh, Intel dropped a lot. I'll take some of that, please. But that's in the retirement account, or our IRA account, which we don't really cover here. This is
and that's because we barely have anything in it.
This is another interesting play. It is USOI. It's a lot like USOI. If you remember, USOI was where they write write notes, exchange traded notes. They actually just write paper on USO stocks. This one does the same thing, but it pays a ton more. As you can see, 230, 142,
Wait, is this a
UTN? This is ETN, yeah.
ETN?
We've made 862 in like...
You got rid of all those.
We've only held this one for 5 months, and we've already made $862 and 20 additional shares, like depending on what the price is doing. I've since turned the drip off on this one. Like we're literally just getting this all in cash, and this is just being funneled into other stuff. This is one of those paychecks I was talking about, along with the next one. The next one we mentioned last week in the retirement account, which is YMAX. I thought.
So we were wrong. Tim was wrong.
I was really happy that I was wrong on this one. I thought once they started doing a weekly dividend, it was just going to suck.
Destroy things.
But the weekly dividend's actually been paying out more than it ever did as a monthly dividend. Like we made 151 here, 80 here, 202 here. We were only making like $60 to $70 per month when it was doing the monthly payments. So the weekly one's actually done quite nicely.
Yeah, happily wrong on that one.
$791 for the year so far, and sometimes the drip's on, sometimes it's off. I think the drip's off on this one right now. I'm just collecting cash because it's a lot. That $201, you can buy a lot of $201.
And just to refresh your memory, YMAX is the one that's the index fund of all the yield max. So you don't have to invest in them individually if you don't want. You can just get in the YMAX and basically hold every yield max ETF they have. And
the very last one is one we just sold in on Veterans Day, 11/11.
It's another bond fund.
The bond right? Fund, YYY, it's at 12.9%. It got overvalued, and I was like, And I was only making like $25 a month in it. It's a monthly dividend payer. And I only made $232 in 10 months. So what is that, $23 a month around there? So I took I want to say we had like 4,000 in this or whatever, and I put it elsewhere. So but it was an overvalued bond fund that wasn't paying too much.
And again, those yields are not bad, but the way the market is and the sectors and the freaking macro climate that's happening, there are way better opportunities to have that money like regenerating.
Yeah. So what did we learn?
I was going to say that's the third bond fund that we sold.
What did we learn? Okay. In the previous quarter that we did this, we had 4,000 $4,558 in dividends in the previous quarter. This quarter, we had 5,368. So we increased our dividends by 17.8% for this quarter, which is pretty tight. We still have the rest of December left to get for the year to date. Right now, we have 14,907. And in 2023, we had 13,685. So we're up 9%. But if you do like I do, to go through and project stuff because I'm a nerd, if we hit like all of our projections, we're going to be up over 23% in year-over-year dividends. So like this portfolio is generating some serious effing money. What else we learned is if you're not holding CONY, NVDY, or YMAX in any your yield max ETF holdings or in your income portfolio, you're seriously
handicapping your ability.
You're leaving a lot of money on the table because they have been ridiculous. Like, so for example, CONY has paid $18.95 in dividends in 2024 per share, which is more than it actually costs right now. So you're actually up over 100%. Yeah. So like had you bought this in January and just turned the drip off, you would be up $19 per share.
Yeah. Like where else can you get 100% yield? Pretty much.
NVDY has paid $18.44 in 2024, and YMAX has paid $6.74. Now there is something that I'm starting to notice, and I'm hoping that.
Oh, I love when he gets pattern recognition mode.
I'm starting to see that the YMAG actually performs better than the YMAX, but if you remember, we have YMAG in the retirement, so I'll have more data, and then next time we do this.
And again, refresher: YMAG is basically like YieldMax, but it's not all of their ETFs. It's the Magnificent Seven.
So if that one actually does better than YMAX, I'm going to transfer the money from YMAX into YMAG.
In theory, it actually should, because again, the Magnificent Seven was the whole reason 2023 was an up market.
Yeah.
The market was mainly up because of the leaders. They tend to drag the thing up, and I think the
I can't stress enough that if you don't have certain YOMAXs, you're leaving a lot of money on the table for your income.
And the lowest risk of all of them, I think, is the YMAX one. Because again, it's the index fund of all of them.
Yeah. That's why we have so much money in the YMAX, because...
And it has a high yield. So if you're going to get in one, I would suggest starting there.
And I touched on this before, like JAPQ versus JAPI, but like just so you know, in 2024, JAPQ is up 26%, JAPI is up 17%. During the last quarter that we did this, JAPQ was up 13%, JAPI was up 5.5%. And JPQ has a 9.3% yield. JPI is a 7% yield. So like every metric that you can measure on, JPQ is just trouncing JPI. So all the people that talk can lick me. Okay. Next thing we learned is bond funds are overvalued. We sold all of our bond funds, and we just picked up PHT to have more exposure to bonds. In all actuality, like when you do a bullet share, it's exposure to bonds too. But
I kind of find that odd, don't you? Don't bonds usually go down when other stuff's popping off?
it's all interest rate related.
That's an interesting market conundrum.
So when interest rates are high, bonds should go up, and when interest rates start lowering, bonds should go down. But they're like,
that's what I'm saying. It's a little bit backwards, or
the interest rate. No one knows. Like they think it's going to go down, but I have a sneaking suspicion that interest rates actually going to go sideways, or possibly up at some point in the near future. So that's why we put money into this other bond fund. BDCs are still rocking.
If they do make the announcement to raise the interest rates, those bond funds are going to fall, right? They should. Yeah. Because they have to write new contracts and they have to be at...
So if the interest rates fall back down to, say, 3%, then like DSU, PDI, and YYY will probably be buys at that point because their prices should go down because the interest rates are going down.
I was going to say, that's when we'll snag them back up
and
again.
I probably will pick them all back up. So keep your peepers peeled.
Or get on the email list because you'll know exactly when to...
BDCs are still amazing, but there's not all BDCs are created equal. I believe that interest rates are going to cause... problems in 2025 because they're going to go down, but then they're going to be held steady, or they might actually go up depending on the inflation, everything like that. So you have to make sure that your BDCs have their balance sheet together. Like you can't like pick up BDCs that have no profit margin or they have like falling revenue. That would be bad. So like that's why Hercules Capital and Trinity and Main Street Capital and Fisker are all like what I think phenomenal. I probably won't get out of them because no matter what happens, they're good managed. Like for example, Hercules has a 70% profit margin. Main Street has an 88% profit margin. Trinity has I think 40% profit margin, and Fisker has like 50%. But if you're not familiar with what profit margin is, that's whenever you take the money you made minus your bills. Net profit margin is what's left over. So the fact they have 87%. Or 50% or 40% net profit margins, that's insane. That means they can pay for sure the dividend with no risk of cutting. And then we never have cash. Like this is one thing I know we've mentioned time and time again. But our biggest problem. Cash is bad. But no, I'm saying when we have money sitting in the portfolio, I can't just let it sit there because it doesn't accumulate things. So I put it in the bullet shares. Got to be in bullet shares. But like if you just have cash laying around, you're wasting your buying power. You're wasting like your future because cash doesn't do squat for anyone. Yeah, and inflation makes it drop like 4% a year if that's even accurate. So the reason we use bullet shares is because like in the last quarter we bought API, CIVI, PHT, PTMN, RWAY, SRV, and UPS. Like I couldn't have done that had I not been putting cash away in bullet shares. You would have had everything in something else, or I would have had to sell a bunch of things, and then like because it is really hard to sell something that's generating and be like, oh, my money's not making anything. Well, that's why bullet shares is freaking phenomenal, and it's like so liquid in the stock market. You don't have to worry about taking it out to try to get a high interest account somewhere. Way better than money markets. Screw money markets. So I'm just saying, like, if you have cash, you need to put it in brokerage. At least put it in bullet shares. Facts. Bullet shares, like you can get anywhere between 6% and like 7.5%. So you're generating that yield with minimal price fluctuation because bullet shares. Yeah, they trade in a very, very narrow band. Go up or down too much. They have a pretty low volatility. So like that's one thing I'm very happy that I actually located bullet shares years ago, and I've been storing my cash in that because it gives me the opportunity when I see like for example, UPS has the earnings report, I can just dump in $1,500 into UPS because I had it sitting in bullet shares. So that's key. And that is pretty much the quarter. We made a ton of money. Rawr! Oh, Tim. Next week is the 2025 prediction. That might be a two-parter, to be honest. It's going to be quite extensive. There's a lot of tickers next week, so I mean, I don't know. Like, she's going to have a fun time putting together the show notes because there's like, I think 50-some tickers that are mentioned. Yeah, that's going to be so that's Jesus. We're going to have like a cheat sheet for that one. It's going to be fun for her, but like there is change coming and there's certain sectors that are going to flourish, and you want to be sure that you are in those sectors foremost. I'm going to go first most. You want to make sure you're in those sectors. And then secondly, once you determine the sectors that are going to pop off, then you can start looking for investment ideas within the sectors. And that's what I did. And there's some bangers. For sure. They're not all income stocks. There's a few like growth stocks. I know, gross word. But hey, profit's profit. Few growth stocks that are just going to be awesome. So that's next week. And the week after that is my whoopsie daisies. And there's a few of those too. Well, actually, I think next week we're doing the capital gains one.
and then those two.
Okay.
Because Tim's still freaking finalizing the details on the next year.
Whoopsie Daisy is a good one.
And we noticed our viewership drops around Christmas, so you guys can play catch up at the end whenever you get through your holidays.
Oh yeah, she's doing the tax harvesting next week. I won't be. I mean, I'll sit here, but I'll just be like, look at the dinosaur.
I don't know if we're gonna have dinosaurs next time.
We'll have a gecko.
Oh my.
A lizard.
Oh my.
So that's it. I hope you guys portfolio is doing like ours. Hopefully, I mean, I'm hoping that you follow like what we got going on.
I was gonna say, I hope
generating a lot of money.
You guys can see we're not full of crap. It's what we're making. We're putting it fully transparent. This is probably going to be the last time that we do this on the podcast. I'm going to move them over to YouTube videos because I just think so much easier for you guys to actually see the chart in front of you while you're doing it, as opposed to trying to listen to this crap and then maybe going back and wasting time doing it. So that's going to be a going forward thing. We'll remind you of that next quarter.
Yeah, next quarter. I mean, it's a quarterly thing that's going to happen every quarter. I want to so you can see. And then the end of year, like probably the end of year details will come out in January, like the first part of January. I'll be like, here's what we made each investment. It's going to blow your freaking mind socks off. What you made on what we made on some of the stuff. So that's that.
All right. So
we're done here.
If you guys aren't here for the next couple, or you watch them late, hope you have a happy holiday.
Holidays.
The
dinosaur says Merry Christmas.
Jesus Christ. Bye, guys.